Larry Fink of BlackRock talked about it in the last cycle too, because they put some stuff on Bitcoin on their website that had the most ever hits on their website in BlackRock history. That they've been all working on this. Everybody from Goldman Sachs to JP Morgan to BlackRock to Apollo to, I mean, you name it, they're all involved. Obviously, Fidelity have been pioneers. Franklin Templeton have been pioneers. So they're all ready. And it seems that it has been decided that I think Gary Gensler, to take some political heat, has said, fine, I'll approve a Bitcoin spot ETF. And I think, BlackRock being the benchmark name to come into it has helped tremendously. And I think we'll get an ETH spot ETF as well, because he needs to be somewhat conciliatory because he's screwed up so badly in what he's done so far. So I think he'll take some political pressure saying, I'm not trying to stop the space. I'm just trying to regulate it. And look, BlackRock are now in the space and we're in safer hands. Isn't that amazing? So, I think that's how it goes. And that also helps because that's going to bring in the RIA networks and others, give them something they understand, which is an equity that they can put into a regular portfolio. But this equity has the kind of exponential upside that crypto has, without the complications of the futures ETFs that just don't reflect the underlying.
A major development is rocking the cryptocurrency world as assets are rapidly flowing out of exchanges. This unusual trend is being interpreted as a bullish sign. It indicates that traders are moving their holdings away from exchanges and have no intention of selling. This phenomenon unfolded on the 24th of October, and it coincided with Bitcoin briefly surpassing the $35,000 mark for the first time in a year. Traders moving their assets from exchanges to more secure storage options is seen as an optimistic signal, suggesting they anticipate a significant price surge. According to data provided by the cryptocurrency analytics company CoinGlass, the largest outflow occurred on Binance, with a staggering $500 million exiting the exchange within 24 hours. Crypto.com saw $49.4 million leaving, and OKX experienced an outflow of $31 million. In contrast, most other exchanges reported outflows of less than $20 million. These outflows have sparked concerns reminiscent of the FTX collapse in November 2022. However, the current situation seems more aligned with trader sentiment than panic-induced withdrawals during the bear market's peak. Glassnode data confirms that Bitcoin outflows from exchanges have risen alongside the increase in BTC's price. The price surge also triggered approximately $400 million worth of short positions to be liquidated. In the past 24 hours, 94,755 traders experienced liquidations, with the most massive single liquidation order occurring on Binance, valued at $9.98 million. On-chain analysts are also paying close attention to the market value to realized value (MVRV) ratio. This metric compares a cryptocurrency's market value to its realized value, calculated by determining the average price at which each coin or token was last moved on-chain. The current MVRV ratio stands at 1.47, closely resembling the ratio during the last bull run, which was 1.5. In the last 24 hours, the total market capitalization of the cryptocurrency market has surged by over 7.3%, reaching a valuation of $1.25 trillion, the highest since April. This surge is attributed to growing speculation surrounding the launch of a spot Bitcoin exchange-traded fund. Let's continue our discussion with Raoul Pal.
I actually think it's going to be everything, everywhere, all at once. So what I mean by that is I think there's several layers of adoption that is being built by teams right now. One is the finance system, payments, right? We're seeing everybody from, all of the payments platforms to stable coins, that there's a lot of payments architecture, CBDCs. Who's going to go first? India's building, it's out. Singapore's building one. China's building one. The Europeans want to do it. The UK wants to do it. So we know that's coming. That's all on blockchain. And then we're seeing the rise of the institutions building tokenized money market funds, people like Franklin Templeton. And stuff like Firedancer and Solana may be giving opportunities for the finance system to use it in broader ways. So we're seeing the finance system get involved. The finance system itself is going to be investing in the space. So we're seeing pension funds. I just interviewed the guys from Texas Teachers, for example. They're investors in the space. They were pioneers. We'll see more of that. I think stable coins continue to grow. It's basically a tokenized euro dollar. Means anybody in any country can get access to dollars. So that's a very big deal considering 87% of world trade is in US dollars. So that continues to grow. Then I think we see the further applications of NFTs. So NFTs right now we know as digital art, which was the proven use case of that you can create digital scarcity on a blockchain. So therefore, in an increasingly digital world, not everything goes to zero in value because we can make anything digitally in infinite numbers, including with AI knowledge. So what we're going to do is create some scarcity. So that was what the art movement was. PFP showed about community in Web3, but NFTs are basically contracts or deeds in the electronic world. So I think that's ticketing. I think that's insurance contracts. I think that's real estate. I think that's a lot of things. So I think we'll see more use cases. DeFi itself. DeFi, we saw the blow up of CeFi. So we understand the fragilities of trying to build a CeFi system on an 80-volt asset. So in DeFi, I think it splits. I think we get more attention to DeFi, but it splits. One is institutionalized DeFi, which has KYC AML because they can't use it otherwise.
Right.
But once they do that, and everybody's working on that, then we'll see massive liquidity provisions from the people who already provide liquidity to financial markets, banks, big super funds like Apollo and stuff like that will start providing liquidity, and the big hedge funds to the lending markets in crypto via DeFi. So that's the money markets essentially. But we'll also see the more kind of traditional crypto native side of DeFi continuing to develop, the Aves of this world and, the makers and all of that stuff continues. And then the derivative exchanges, DXDY, Deribit, all of this kind of stuff. So, and the final part of the equation is I'm seeing still a lot of brands and cultural communities interested. So that's sports, music, fashion, entertainment. And I think all of those will grow into the space once they get through this. Everyone's a little bit insecure about the market right now, and nobody's got much money for marketing budget, but I think we'll see the rise of that. So I think all of these come together this time because I think most people did the work in the last cycle. Then the cycle, the cycle died off, but I think most people have teams, Web3 teams, across all of finance to big brands, and they're ready to activate. They're just waiting for more liquidity to come back and a bit more certainty. So I think the narratives will be broad. Sure, there'll be some breakout narratives. The other one is gaming. That's the other one a lot of people are waiting for, is how gaming fits in. So there's a lot of narratives coming, and I think they'll all come together at the same time, which will make it, I think a lot of people will have the light bulb moment this time around. My view is that the whole global business cycle, including the crypto cycle, is driven by the debt refinancing cycle. So if you cast your mind back to 2008, 2009, we had a global reset, and people didn't really realize at the time what it was, but people were looking for a reset that nobody had to pay debts or something of that form. But what actually happened is they said nobody needs to pay interest on debts. So everybody set interest rates to zero back in 2009. Since then, every major economy refinanced interest rates at every 3 to 5 years. So we've got this 4-year cycle that happens to be the same as the Bitcoin halving cycle. And we see the economy, what happens is as you get later cycle, inflation picks up, interest rates pick up, the economy slows down because the economy really doesn't grow fast enough to pay the interest payments. So cut forward to today, where we are is a position where interest rates have gone up a lot because inflation went up a lot because of the pandemic. The economy's slowing down. And now the interest payments are due from the pandemic from 3 years ago. And those payments just keep accelerating. And we've seen the bond market get very unnerved by this, by the amount of issuance that needs to go on to pay all of the interest on the debts, the previous debts, plus the new debts. So at some point soon, the Fed will have to stop quantitative tightening. We saw something similar back in 2018. End of 2018, the bond market blew up. That time it was actually the repo market, but part of the bond market blew up. And the Fed kind of started saying, okay, we're going to stop raising rates. Then eventually, several months later, they stopped doing QT and eventually cut rates. So I think we're in the similar kind of zone where the Fed have stopped raising interest rates. And soon they'll either have to stop the bond market, bond yields rising by something called yield curve control, or the inflation falls fast enough that they've got the cover to start cutting rates again so that they can roll these interest payments at a lower level.
If you enjoyed the video, don't forget to give it a thumbs up and subscribe to our channel for more daily updates. Remember, knowledge is power, and we're here to empower you on your financial journey. Until next time, happy investing.